Hey everyone, Eric here. In today's video, we're going to learn about the startup unit economics journey for two-sided marketplaces. By the way, if you missed part 1 about SaaS, make sure to check it out. I'll include a link below. Okay, let's get started. Okay, so in this video, we're going to quickly cover what unit economics are and how you want your unit economics to evolve over time as any startup and what that means. Then we're going to talk a little bit about marketplaces and some of the specific metrics that have to do with two-sided marketplaces because they're a very unique and complicated business model. Then we're going to dive into a case study, and we're going to look at the same marketplace startup but in two parallel realities. In one reality, it's doing well. We're going to track it from the idea phase, MVP, early stage growth, and late stage, and an exit, and how the unit economics sort of evolve over time with some benchmarks so that if you're working on a marketplace, you can also benchmark your performance. Then we're going to look at the same startup, but in a parallel reality where it's doing negatively and it's scaling up, but not improving its unit economics. We're going to have a lot of discussions around retention, and we're also going to cover how to break down the CAC of a marketplace, which is a little bit tricky. So make sure that you do that correctly. Okay, so let's dive straight in. So the basic idea with unit economics is you want your unit economics to get better over time. If they're getting worse over time, it implies that your business will get progressively less profitable as it grows. So if each incremental customer makes less money, your business at 10 or 100 times the size should either be completely unprofitable or losing more money than it's losing today. So the unit economics of each marginal customer should be better than the last because that implies that your business, if it's much larger, will make a lot more money. So that kind of makes sense, and that's how investors are thinking about unit economics. So the definition of unit economics is it's basically the revenue, costs, and profit you make on one customer over their entire lifetime or relationship with your company. So you have the marketing cost that you spend to get that one customer to buy for the very first time. That's called your CAC, your customer acquisition cost. AOV is how much your customer spends on average when they make one order. Gross profit is how much the company makes in profit from that average order, so your revenue minus the direct costs. Then you have your customer lifetime value, which is how much gross profit a company makes from their relationship with that customer over the lifetime of orders. So maybe on one order you might make $50, but if that customer buys from you 10 times over 5 years, you would make $500. That's called your customer lifetime value. And then the LTV to CAC ratio is how many multiples of gross profit does a company make compared to the marketing expenses it incurred to acquire the customer. So if I spent $100 to get a customer to buy from me on marketing, and then on their first order, I only make back $50 in profit, well, I actually am in the red $50 because I spent $100 and then I only made $50 back. But if that customer goes and buys from me 10 times total, then I will make many multiples, and that is the LTV to CAC ratio. So you want this LTV to CAC ratio to be, it depends on the business model, but with marketplaces, 3 is a good benchmark, and we're going to get into that. Marketplace definitions. So marketplaces are complicated because they have two sides. They have buyers and sellers, and our business is to actually create the software that sits in between them and connects them. So there's always one hard side of a marketplace, and it's very good to be aware of which side of the marketplace is the harder side. So one side of the marketplace is harder to acquire and retain. It's usually sellers. Sellers are usually difficult to recruit. They have a lot of expectations around financial outcomes. They will switch easily if there's another place to sell their goods. There's one exception, talent marketplaces, so like job marketplaces. Employers are actually the hard side. So those are actually the buyers of the product. And so it makes sense because those employers spend all the money and they have a lot of options in terms of where to hire people. And so those are the hard side. But for pretty much all other marketplaces like Uber, rideshare marketplace, the drivers are the hard side of the marketplace. Riders are relatively easy. If you have a lot of drivers, it's easy to get riders. But just because you have a lot of riders doesn't mean it's easy to get someone to change their career to buy a car and become a driver. Supply versus demand constraint. Usually one of the sides of your marketplace is limiting your overall growth. If you don't have enough drivers, then the riders can't make rides and you can't generate revenue. If you don't have enough riders, then your drivers can't do rides and you can't generate revenue. So you need the two sides of the marketplace to be in sync with each other and scaling at a similar rate. And usually you can diagnose which side of your marketplace is constraining your growth. Gross merchandise value, this is the total spend on the consumer side of the marketplace. That is not our revenue. Just because someone spent $100 on the marketplace, we don't collect $100 because most of that revenue goes from the buyer to the seller. So the revenue that's actually ours is something called a take rate. So usually marketplaces take around 20 to 30% of the GMV as revenue. So if you go to Airbnb and you book a place, Airbnb might take about 20% of the total booking for themselves to run the software platform, and then the seller of the Airbnb takes like 80%. So our revenue is not the GMV; it's the percent that we actually take back to the company. Then user retention cohorts. This shows the continued activity of a set of customers over time. So one issue with a lot of startups is they say, okay, 30% of our revenue is recurring, but that doesn't tell you anything about the composition of the recurring revenue. You know, are these customers who bought last month for the first time, or did they buy 5 years ago and you have really sticky customers? And so these are retention cohorts, and we're going to get into how to use these to really understand how sticky your customers are and to kind of look at them on a chart. And then customer acquisition costs, we just covered that. But the issue with marketplaces is because you have to acquire buyers and you have to acquire sellers. So there's a CAC for both parties, but there's only one transaction that they share. So you need to actually look at both sides of the marketplace and create a calculation to combine the CACs based on the revenue that was generated. I'm going to show you how to do that in a sec. And then the customer lifetime value, again, you need to actually look at this from the perspective of either the buyers or the sellers, but not both because they share the revenue. So revenue happens once, marketing happens twice. So let's dive into this case study. So for our case study, we're going to assume that we're going to calculate LTV, CAC, everything from the buyer perspective. And this is a two-sided antique buying selling marketplace. You could also look at this from the seller perspective. That would also be correct. They're both acceptable. There needs to be a discussion at your company of sort of like who is your customer and how do you think about the mechanics of your business. But in our situation, we're going to say we're going to break down the LTV to CAC ratio from the buyer perspective. Okay, so let's get into this. So here in the idea phase, we have no customers, but of course we want to break down the unit economics to figure out, you know, what do we think the average person is going to sell? How often do we think they're going to come back? How can we onboard all of these antique vendors? And ultimately, what kind of business are we trying to build long term? And the MVP, we're saying that we've signed on 50 buyers and 10 antique sellers. And so this is when we're quite small. Early stage is when we're scaling towards 1 million of gross merchandise value. Growth, we're trying to scale towards 20 million GMV. And then late stage exit is when we're trying to scale towards 250 million GMV, which starts getting us towards a very large valuation in the hundreds of millions or maybe up to $1 billion. So in the idea phase, we say that we have a $50 CAC. So here is actually how we get to that CAC. So because CAC is a combination of buyers and sellers together, here's how we think about CAC with marketplaces. So you need to first decide, how are we calculating CAC? Are we thinking about it from the perspective of the buyer or the perspective of the seller? Both of them you can calculate the CAC for. You just need to decide. So in both scenarios, we're saying that through all of our marketing channels, it costs us $25 to get a new buyer. And it costs us $250 to get a new seller because the sellers are the hard side of the marketplace. They're going to be harder to acquire. And then on average, there are 10 buyers per seller. So how many sellers are there per buyer? There's 1 divided by 10. So there's, there's for every 1 seller, there's 10 buyers. So the CAC is a weighted average of the proportion of each side of the marketplace times their CACs. So let me just show you how to do this. So you would effectively say 25. So because we're doing it from the buyer perspective, we add in 25. We know there's 25 from the buyer. But how much of the CAC is associated with the seller? Well, we only need we need one seller for every 10 buyers. So it's really just 1/10 of the CAC, 1 divided by 10. So 25 for the buyer, and for the seller, it's 250 times 0.1. So those added together shows you the CAC of the buyer plus the CAC of the seller added together is $50. So this allows you to capture the marketing on both sides of the marketplace. If we were trying to do it from the seller perspective, you would effectively say CAC of the seller here, buyers per seller here, buyer CAC here. And so if you wanted to say seller CAC, you'd say, okay, we know we have the CAC from the seller, and we know for every one seller, we needed to acquire 10 buyers. So we say 25 CAC per buyer times 10 buyers. So that's actually 500 from the seller perspective. And then, of course, the LTV of the seller would be higher as well. But that's how you can look at it if you want to calculate it from one side or the other. But we're talking about buyer CAC. Okay, so buyer CAC is $50 in our idea phase. And now we move into the MVP. So we see really what happens. So we're saying that our average person, we hope, spends $350. The average revenue is 25%. So 25% of the GMV is our take rate. So that's what we bring back as revenue. Gross profit, we're saying, is 85%. Remember, marketplaces are software businesses, so they usually have very, very high gross profit margins, can be 80% plus. LTV, we're basically saying, is 1.8 times the gross profit on one order. So we're saying the average customer, we think, buys almost twice. And then over 3 years, we're saying that actually they buy about twice what they buy in the first year. So the LTV over a 3-year period is $268. So the LTV to CAC ratio in year 1 is 134, and over 3 years, we want to hit over 5. Now, why am I talking about 1 year versus 3 year? Because for marketplace benchmarks, these are a lot of the ways that investors actually think about a payback period. So for marketplaces, if you can make 1 to 1.5 times your LTV back compared to your CAC ratio in 1 year, that's considered a healthy marketplace. And over 3 years, if you can make 3 times your LTV to CAC, then that's considered a healthy marketplace. And you know that in year 2 and 3, the retention is going to be less strong than in year 1. So those are benchmarks that sort of like the tier 1 venture investors are sort of thinking about. And one quick thing, if you're finding this content valuable, please subscribe to my channel right now and like this video. Also, if you want me to teach you everything I know about finance for startups in a small group with personalized support from me, join the waitlist in the description below for a chance to join the next cohort of my training program, Finance for Startups. Okay, let's get back to the video. MVP, we have 10 sellers, we have 50 buyers. We actually were able to acquire both sides of the marketplace for a blended CAC of $37. GMV was only $212, so it's a bit lower, but we are doing some discounting. We're doing things to try to onboard new people. And so our revenue, we're saying we didn't take 25%, we took 15% because we're starting out. So our gross profit was only $21 per order. So it's obviously lower than our vision, but we know we're trying to build backwards to that vision in the future. So your LTV from a 1-year timeline, we're saying was 0.84. And then we don't have 3 years of data, so there is no 3-year LTV. So that's not applicable. So our target was 1, we're about 0.84. But given that we just launched, we think that those results are actually pretty good because we know we can start increasing our take rate. Maybe we can start monetizing the marketplace in other ways. Now we're scaling towards $1 million GMV. So let's zoom out a little bit. Early stage. Now we've onboarded 300 sellers. You know, let's say this was, I don't know, during the pandemic and a lot of the antique stores were closed for a period of time. We said, hey, move your business online. And we had a boom of sellers come online. And all these buyers came to buy different things. And so now we're scaling towards GMV. We're in the early stage, so we're maybe raising like a seed round. Our CAC goes up a little bit, but still at a very manageable level of $47. The AOV starts to increase. So it's $264. We've increased our take rate a little bit from 15 to 20%. And our gross profit went from 65% to 75%. So we're actually generating better contribution margins now. So now our 1-year LTV ends up being $67, and our 3-year LTV is $101. So let's look here. How are we doing versus our benchmarks? So our 1-year LTV to CAC ratio is 1.4. So actually that looks pretty good to me. And the 3-year is about 2.15. So we obviously need to improve our customer retention a little bit. And now that we're talking about customer retention, let's move over to the customer cohorts. So with marketplaces, let's talk about the buyer retention cohort. So when you have a buyer, and then you're 1 month later, 2 months later, 3 months later, 4 months later, a lot of startups will just say 30% of our sales are returning, 50% of our sales are returning, 10% of our sales are returning. But that's almost completely meaningless. It doesn't really tell you anything. The real way to understand and also present your customer retention data is through a cohort. So this is a buyer retention cohort. So the way that you interpret this data is you basically say, okay, in June 2023, 530 people bought for the very first time, and this is considered M1 of their lifetime. 1 month later, and the second month of their lifetime, M2, so if this was June, that would be July, 265 people returned of those original 530 people. So if this is the 530 here, 50% of the 530 people actually returned in the second month. 1 month later, so June, July, August, 226 people returned of the original 530. So you look, actually 43% of the people in month 3 of their lifetime of the original 100% are actually still buying. In month 4, 256, so 48% of the 530 are still buying. And so this allows you to look at the entire stream of repeat purchase behavior from a cohort of customers. And a cohort basically means a group of customers that bought in the same month. And so what you can do here is you can look at different customers. These customers bought for the very first time in July, and then here's their retention. So the July customers, they bought, in the third month of their lifetime, 35% of them were still buying. In the 7th month of their lifetime, 25% of them were still buying. And so when you can compare across cohorts, let's look at the 3rd month of the lifetime of all these different groups of people. You can see that the retention is pretty stable across them. And you can see that in month 8, 24% of customers are still buying. And so this is really the way to break down customer retention for a marketplace. And not only just for one side, but you can actually look at both sides of the marketplace. You can look at the buyer side and the seller side. I'm going to make another video that goes really deep on marketplace retention. So I'll include a link to that below when it's done. But this is how you should be thinking about retention. And what you can do is you can just turn this retention cohort and just pop it into a chart. And this allows you to basically look at, okay, here's the June cohort. So this is kind of over the months of their lifetime. How did their retention look? And so here you can actually relay all of the cohorts over each other to see, are our newer cohorts continuing to have strong retention? Is retention getting worse or better over time? And this is going to be the best way for you to really understand on the buyer and also on the seller side. Are you seeing a decline in retention on any side of the marketplace, or are you seeing really strong retention? And that's going to help you understand what's driving your unit economics and also what's driving your revenue growth. Okay, so let's get back to the early stage. So here you can see our gross profit was 40. Okay, so we went through the LTV to CAC ratio. And again, we want to make 1 to 1.5 times our LTV to CAC ratio in year 1 and sort of 3 plus over 3 years of the customer's lifetime. So in growth phase, now we're scaling towards 20 million in GMV. We probably raised some money at this point. Now we have 100,000 active buyers, 6,300 active sellers. Our CAC is up to $51, so it's increased a little bit. But the good news is our AOV has gone up. Our revenue has gone up. Now our take rate is 22% of revenue. And our gross profit is now $53 per order. LTV over 1 year is $101. So now it's about 3 times where it was in the MVP phase. And over a 3-year lifetime, it's $202. And so our LTV to CAC ratio in the first year is almost 2, and in over 3 years, it's about 4. So we're actually in a really strong position now. And so we're probably able to raise more money burn less money along the way. Now we're scaling towards 250 million in gross merchandise value. We have 1 million buyers. We have 80,000 sellers. CAC is $56. LTV at this point is 150, and the 3-year LTV is 295. And so, we're making 2.6 times our CAC in LTV just in the first year, and more than 5 times our CAC in LTV over 3 years. So this is a business that could be valued very, very highly, hundreds of millions, maybe $1 billion, and can become very, very profitable because its unit economics are they're making a lot of money on each customer. Okay, so now let's look at this second company where the metrics start to diverge. So the idea of the company is the same. The idea phase, same exact unit economics here and here. In the early stage, we have the same CAC, same AOV from a GMV standpoint, same revenue, so the same take rate, and the same gross profit. The issue is you start to see the difference here in the LTV. So here it's $31 and here it's $25. So that basically implies that there's lower customer retention over the first year of the customer lifetime. So the LTV to CAC ratio now is 0.67. So they are not even getting close to breaking even. They're losing money on every incremental customer. But maybe they think, we just have to increase our take rate. We want to capture the market now and raise money later. And that was a very common narrative, especially over the last 5 to 10 years. A lot of businesses scaled to sort of enormous scale with negative unit economics, and there were investors ready to fund those businesses. So let's say they raise some money to keep scaling. CAC now is $61 versus $47. The GMV is the same, but the revenue AOV is lower. It's 53 versus 40, so the take rate is a little bit lower. And then the gross profit ends up being $24 per order versus 40. So the gross profit margin is a bit lower. Maybe they're overstaffed or they don't have great systems set up, and so they're not generating as much profit per order. And of course, that flows through to the customer lifetime value. So $36 versus 67. And then over a 3-year period, we're seeing only 53 versus 101. So the metrics are about 50%, the more positive scenario. So in the first year, we're not making our money back. We're only making 0.6 times our CAC in LTV. And even over 3 years, we're only at 0.9. So we're still losing money on every single customer, even over a 3-year lifetime. So let's say this business keeps raising money and keeps scaling. So the CAC now is $71, so it goes up a little bit. AOV from a gross merchandise value standpoint is the same, but the take rate remains at, here it is 16%, and here it was 22%. And then here the gross profit margin was 85%, and here it's only 55%. So again, the LTV is only $42, so it's going up over time, but it's not going up fast enough to cover the CAC. And even on a 3-year standpoint, still not covering the CAC. So we're not getting close to the 1 to 1.5 times CAC from an LTV standpoint in year 1, and 3 times your CAC in LTV by year 3. We're not even close. And so let's say this business somehow was able to say, well, look, our unit economics are improving, our revenue per order is improving, our gross profit per order is improving. So if you play that out, eventually we're going to continue to make more and more money and we'll be profitable. And so investors say, okay, we'll keep funding this. So by the time that this business is fairly large, CAC goes down a little bit. Maybe they're experiencing some network effects. So you can see here the CACs are actually pretty similar. So the marketing funnels of these two businesses are both functioning well. The issue is you start getting into the revenue, so the monetization of the customers is worse in this scenario. The gross profit margin is not as high as it should be for a software business. Software business should have 70, 80% plus gross profit margins. And then their customer retention is worse here. So here you see the CAC is, the LTV is only 46, and on a 3-year basis, it's only 74. So finally, on a 3-year basis, we make back our CAC, but we're still barely making money. And so the issue with marketplaces, because customer acquisition needs to happen for two sides. So both parties need to be acquired in a transaction. If you have people dropping off, your CACs can, even if the CAC itself is stable, you have to spend a huge amount of money on marketing to reacquire customers. So if your sellers are churning and your buyers are churning, both very quickly, then you're going to have to reacquire them constantly to bring them together for the transaction. So if we could see the full financial statements for this business in the second scenario, it would probably be burning enormous amounts of money to keep reacquiring customers to keep its growth going. But this business, because it has better retention, it doesn't need to spend nearly as much money on marketing, because once it acquires a customer, that customer buys a few times. Rather than in this business, when they acquire a customer, that customer maybe buys once or twice. And so this business would probably have a very hard time getting towards break even or profitability. But once you start getting to be a late stage business, you need to be able to start showing free cash flow positive metrics. And so this business probably wouldn't be able to do it. Okay, so I hope this gives you a good idea of how unit economics should evolve over the life cycle of a marketplace startup. Also, I'll include links in the description below to the other videos in this unit economics journey series, which are about SaaS and e-commerce. Also, if you want me to teach you everything I know about finance for startups in a small group with personalized support from me, join the waitlist in the description below for a chance to join the next cohort of my training program, Finance for Startups. As always, you can download this Excel file completely for free in the description below. If you found this content valuable, please like and subscribe. Thanks for watching, and I'll see you in the next video.